Today, we're talking about the economy and the Federal Reserve's recent efforts to battle rising inflation. We're also discussing, most importantly, what it all means for you, especially if you're in or near retirement. So now it's time to bring in our guests. First, Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida. Jeff, as usual, always good to see you.
You too, Dave.
And we also have today's special guest, Harry Dent. Harry's the editor of the Economy and Markets newsletter, available for free at harrydent.com. Harry, great to have you back here on the Income Generation.
Yeah, nice to be back, David.
Lots have happened, Harry, since you've been here. I mean, look what's going on in the world. I think you were somewhat prophetic when you said in January, big drop in a few weeks, the markets peaked. Didn't quite hit your numbers with a 40% call, but 29% on the NASDAQ. I give you credit, is close enough. What do you foresee happening from here?
You know, I think we're in what I call the first wave of a major bubble crash. And it does tend to be anywhere from 28 to 50%, average 41% in the first several months. So I think we're in that, and I think we're just taking a bounce, and we have one more wave down of that. So we might see closer to 40% on the NASDAQ. Right now, the NASDAQ's been down 32% at worst, the S&P 21%. I do think the NASDAQ could get closer to 40% by mid-July. So I think we probably have one more wave down of this. Now, that's important because that confirms that we've seen a top. Once you see a crash in this 30 to 40% wave after a bubble like this, that's what it takes to break a bubble, by the way.
Sure.
20% doesn't do it. And that's why the S&P is not broken yet. But I think the NASDAQ and the Russell 2000 are. But one more downturn would really confirm this to me. And then the rest of the trajectory, you'll get a bounce after that, and then it'll go down for a couple of years more in a more predictable manner. It'll just keep dribbling down, and
Sure.
That's much easier to.
Before you can really get into the bear market, you have to break investors' will, and that hasn't been broken yet. So, okay, we're in a dead cat bounce right now. I get it. We'll see another low before we go into phase two. You know, what's your best guess as to how many years it takes before the S&P 500 gets back to where it was on January 4th? 5 years, 10 years?
Well, you know that the next boom, it will be the millennial boom. It's not as big a boom. It's not as long a boom. It'll be from 2000, I'd say 2024 roughly through 2037. The baby boom was from 1983 through 2007. So that was much longer, much bigger ride, much larger generation relatively. So this downturn is likely to bottom somewhere around late 2023, early 2024. Now they pushed it back so much, it may take longer, but the next boom should be in that time frame, 2004 to 2037. So that's when the stock markets will be moving up on their own from fundamental health of the next generation spending. Ever since 2008, it's been all stimulus.
Of course, now that's only 2 years away, but you're not saying that we're going to get back to January 4th levels by 2024. It's going to take a few more years to recover off the trough to get there, correct?
Yeah, let me be more clear about that. We would be lucky at the top of the millennial boom in 2037 to get back to these levels. I don't think we will, because this has been in a bubble era, like in the roaring 20s, where valuations are just much higher, and this has been an everything bubble. Real estate, stocks, commodities, gold, even gold. People say gold is the answer. No, gold bubbled even more than stocks. And commodities have been crashing and will crash more. So I think at best we get back to January 4th levels, 2037. And more important, by then, the U.S. has seen its WAD. We don't have. Births went down after 1990 and continue down. We don't have a generation to follow the millennials yet of any size.
That's right.
And the millennials are like a 5-foot wave compared to the baby boom 10-foot wave. So this next boom won't be as strong, but it will last a long time. We can invest for the long term if you call the long term 2037, starting around 2024.
Got it.
Well, someone's got to be the contrarian here, guys. And so I'm going to go out on a limb because I know we're going to be talking to Harry between now and the end of the year again. But I'm going to say we close at 49.50 on the S&P at the end of the year, as long as oil stays under. As long as oil stays under 125. I think inflation is going to moderate organically more than we realize because of the pullback from stimulus. OPEC is going to open up the floodgates to keep oil prices where they are because anything over 125 crushes demand. And so
Harry,
if that happens,
Harry,
I'm
straighten
going
them
to be
out
right.
for me, please.
Yeah, I do not. I think we have made a high. I will confirm that 90-some% if we get one more downturn and go a bit lower. I think we have seen the high. I do not think we will see a new high for so long. It's not even worth talking about. I don't think we're going to go back to the highs by the end of this year. I think we're going to see this first wave down into July. We're going to have a bounce for a few months, retrace maybe 30-40% of that at best, get nowhere near the highs. And then when we face another big wave down, I think this is it. They have put this off forever. The truth is we should have had a bigger crash in 2008, should have lasted into 2010, gone much deeper. And then we'd have had a rebound in 2019, and we should have had a second crash, Great Depression crash from 2020 into now, and we're just topping recently. So they pushed this back so far. I think we don't see a new highs in real estate, maybe ever. And in stocks, I think we'd be lucky to get back to these levels of 2037. I would bet that we don't even get back to these levels in my lifetime.
December
Wow.
31, Harry. December 31. We will be at 49.50.
Good luck on that one.
December of 2031, because if
No,
so, Harry
December
was
of
successful
31 of
pushing-
this year. By the end of
This
the
year,
year,
he said.
the market will have recovered. Look, we can't all say the same thing here. Okay, we got to make this entertaining.
I will say one thing in that favor, because the S&P has not gone down enough for me to say that was a major long-term top. And if it's not a major long-term top, the markets couldn't go up and make a slight new high later this year. So I do want to see the NASDAQ go down one more time closer to 40, and the S&P can get more in that down 30-ish stage, and I'll say, yeah, we will not be back up there. Not only this year, but never in any time frame that would matter to somebody.
All right,
now.
all right,
But
Harry.
I can't confirm that yet.
So Harry, great. Leave me on the island by myself then. Thank you very much. But no, I go with your first prediction, though. I really don't. I agree with you. I don't think it's likely we'd see new highs. I think the highs are in for the year.
Look, the Fed is tightening. How are you going to go to new highs when the central banks are tightening? And they're only tightening because they created a sudden surge of inflation by panicking after COVID and printing $5 trillion monetarily and then adding $5 trillion in fiscalus. That's 50% of GDP. We ought to be growing at 20% with that. So they panicked. They've overdone it. So they don't get to stimulate anymore. They cannot. And this inflation is telling them, put on the brakes. And I'm saying this economy is so weak demographically after all this stimulus that just not having new stimulus is enough to throw us into a deeper.
So Harry, final thoughts. Our people watching this, are either retired or within 10 years or so of retirement. They're going to want to generate income from investments, but what do they do? Give us your final thoughts for the average
this
person
is the most
watching.
important question, because this is an everything bubble and an everything crash. There is no place to hide, but the thing that does the best in the early 1930s, a crash of this magnitude, or 2008, which is a smaller version of what we're getting ready to see, the one thing that went up, which does generate income, was the U.S. Treasury bonds. So a 30-year Treasury bond will give you a little over 3% right now. I know that's not great, but if we go into this deflationary downturn and stocks go down and real estate go down and gold and commodities and everything, the Treasury bonds will go up. They went up 40-some% in the 2008 crash while paying you a small interest, and they will go down up, I'd say 50% plus. So it's the only thing I see going up, and it is an income based. It is the safest asset, long-term asset bond in the world. U.S. 30-year Treasury bonds are the best thing to buy. There's two ETFs that are easy to buy. ZROZ, a little less liquid, but liquid enough. 25-year average Treasury bonds held between 10 and 30. And TLT, extremely liquid and easy to get in and out of. 20-year average. Those are the things that will go up. I don't have any other recommendations other than cash, and I'd rather have these bonds because they appreciate in a deflationary scenario. They are the safe haven, and the gold bugs that think gold is, should just look back at 2008. Gold went up at first. Oh, I'm the safe haven. Then the crash got bad mid to late 2008. Gold went down almost 50%. Was not the safe haven.
So, Harry, we need to leave it there for now, but I was actually, if you saw my face, I was cringing just a wee bit because I thought you were going to say gold. But most people now are poo-pooing long-term treasuries, and you always go
They
against...
think the U.S. government's going to go bankrupt. We're the best house in a bad neighborhood. Our bonds, they will run to us. Mark my words on this. U.S. treasuries, and you'll get 3%.
Yep. Harry Dent, never one to be afraid to go against the crowd. Jeff Small, Harry Dent, thank you so much for being back here on The Income Generation. Thank you for watching today's video. If you've enjoyed it, click the thumbs up button to give us a like, and make sure you subscribe to our YouTube channel for new content each and every week.